Going now to Senator Canavan.
Thank you very much, Chair. Thank you, Ms Bullock. Ms Bullock, is the RBA bankrupt?
No, the RBA is not bankrupt. We can still continue to meet our operations and perform our operations and meet our debts and so on. So no, we are not bankrupt.
In your annual report, I'm sure you're aware in the statement of your financial position, for 2022 you have net negative equity of $12.5 billion.
Yes, that's right.
I mean, on what basis are you, in a normal world, a going concern with net negative equity of $12.5 billion?
There's a couple of reasons. One is because we actually have the ability to create money, if you like, so we can continue to meet debts and we can continue to pay. The second reason is that ultimately the Reserve Bank is guaranteed by the government, and if you think about the $12 billion in the context of the government budget and GDP, it's actually very small.
I'll come back to that.
We're not.
You're probably aware, Mr John Keogh wrote in the Australian Financial Review that if the Reserve, this was on September 21st, I think when your accounts perhaps came out, he said if the Reserve Bank of Australia was a commercial bank or hedge fund, it would be bankrupt. So yes. Do you disagree with that? Because it sounds like the only reason you're not bankrupt is because you can print money, and obviously a commercial bank can't do that.
Yes, because the central bank is not a commercial bank. Yeah, that is true.
Now, your financial accounts obviously are the ones I read out were as of the 30th of June 2022. What's the equity position of the Reserve Bank today?
I'd have to take that one on notice. It would depend very much on opposing forces. On the one hand, we've had a depreciation of the exchange rate, which will have increased profits. On the other hand,
had rising interest
we've
rates.
got so. I'd have to take that one on notice.
Come to drilling down. A big reason for these extraordinary losses that do, as you say, you're part of the Commonwealth Government. This is Australian taxpayers bearing the cost of these losses, and I don't think they'd accept that $12 billion is a small amount of money. The losses are higher than that too. That's just the negative equity position. Presumably, since the 30th of June, interest rates have gone up significantly, and a lot of these losses are because interest rates have gone higher than your holdings of long-dated or longer maturity bonds. Is that correct?
So a lot of the losses, as you highlight, the bulk of the loss has come from marking to market our holdings of Commonwealth Government securities.
Yep.
So the extent to which yields have gone higher than they are, prices have gone lower than they are on our books, then yes, we'll make some more losses on those. The bottom line on that, though, is that we're holding them to maturity, and ultimately now they're at a price lower than we will get back for them, so they will result in realised gains at some point.
I'll come back to that just before I do get to that point. Presumably you would have an idea, I'm sure, whether your equity position is better or worse than the 30th of June. Is it better or worse than on the 30th of June of this year?
It's slightly better, I think, but can I take that on notice, please? Because it moves around so much day to day.
And you don't mark to market every day, I presume?
No, but we can get some, we can put some numbers in and get some estimates, but we do mark to market every day, but we can get you that. But all I'm saying is the exchange rate's moving, interest rates are moving, things are quite volatile, things change day to day. So can I take it on notice, please?
Have you asked the government for an equity injection?
No, we have not.
Have you at all prepared advice to the government about the need for an equity injection?
No, we have not.
I noticed that the New Zealand government, New Zealand Treasury, has provided the RBA there, its Reserve Bank, its central bank, an equity injection. Why haven't you considered doing similar? We have done that in the past, I know. Why, with a negative $12 billion position, why aren't you asking the government for an equity injection?
The board discussed this, and I think we mentioned this in the annual report, but we felt that given the fact that we will start to make profits again in the future, that there is a viable path for rebuilding equity and coming back to positive equity and capital, and so there was no need to ask for a capital injection. I might come back to that if I've got time, but limited time.
I just wanted to go to the yield control policy. What are the mark-to-market losses on that policy?
Much smaller on the bond program, but I'd have to get back to you on that as well.
On the specifics, it's
because that also changes over time.
I mean, some people I speak to in financial markets are not impressed by the transparency of the Reserve Bank. They say to me, at least, that Reserve central banks overseas are publishing their losses, their mark-to-market losses on individual components of the QE policy. Is that, do you think it's a fair criticism of the Reserve Bank?
Not, well...
We have published quite a bit of information on that.
On yield control curve?
Yeah,
I didn't even find the yield control curve wasn't even mentioned in your annual report.
In the yield target review, I believe the numbers are in there.
Right, okay. Why aren't you selling some of the longer maturity bonds you hold that you accumulated during the yield control curve policy, given that you would potentially, I don't quite accept the point you made earlier, Mr. Bullock, wouldn't you potentially limit your losses? If interest rates are going to go up in the next few years, the losses will continue to accumulate on these low yielding bonds. Why wouldn't you consider selling them now?
It's actually just a matter of timing. It doesn't make any difference to ultimately the profit, whether we, if we sell them now, we realise the losses, right? If we don't sell them now, we sell them when they mature, we get the face value, and that'll
But those losses are dependent on the future path of interest rates, right?
It's timing. It might mean we make more unrealised losses in the meantime, but when they mature, we get a bigger gain, a big realised gain, because we're coming from a lower position on the price. So it's a timing matter.
I mean, one point of doing that right now, that would help normalise the curve because you are in a tightening cycle. So selling those longer maturity bonds now would help increase interest rates at that part of the curve marginally, but at least some part. Why wouldn't that be consistent with the Reserve Bank settings right now to try and tighten financial conditions?
I think the point is that the main reason for having the bond purchase program on the way down was we had reached the effective lower bound of the interest rate. We don't have that restriction on the way up. The primary monetary policy tool now is the overnight is the cash rate.
That's right.
effect.
I'm going to get to the
So the I think the estimates of the impact of the bond purchase program on long-term rates was 30 basis points. So it's at the.
So yeah, I wanted to get
So it's at the margin.
You're saying there, you're effectively saying there's a trade-off here between cash rate rises and the sale of government bonds at longer maturities.
No, there's no trade-off.
Well, it's the same. I mean, you're effectively selling bonds overnight, if you like, when you're taking the cash rate. So you could also tighten financial conditions by selling bonds you hold 2-year bonds, don't you?
At the margin.
At the margin, that would be true.
The point is that you can have a very direct effect by just pricing.
I'll
let Ms. Bullock answer the question.
Because we're on time limits, though. Sorry, Chair. That does.
Did you want to rephrase the question?
No. I just the reason I am sometimes interrupting is because of the 10-minute time block. So because I need to get through things. But sorry, we're interrupted there. I'm just getting to this point about the trade-offs here between cash rate rises and taking action at other points of the yield curve. It seems to me, as you've just admitted almost, that homeowners will have to pay 30 points more on their home loan because you're bailing out hedge funds and investment banks by not selling these other bonds, the 2-year bonds that you hold.
I think the main impact, as I said, is the cash rate, and we don't have a limit on that like we did on the downside. We don't have it on the upside. So what we're doing with the running down the bonds that were part of the bond purchase program is we are letting them run off as they mature, so they gradually tighten. That's 30 basis points over a period of 10 years. It's marginal in respect of the monetary policy. I don't think 30 basis points is
marginal for the average Australian mortgage holder, Ms. Bullock, and here I am very concerned that you have a very cosy relationship with banks in this country, that some of them have taken similar positions to you on interest rate movements, and by not acting on this part of the yield curve, you're protecting their interests and potentially requiring Australian mortgage holders to have to pay higher interest rates to meet your tightening objectives.
So to the extent that we are tightening, and if your argument is correct, then we have to tighten less on the cash rate because of that. So these things work together. They don't work in opposition to one another. So the amount we need to tighten will also depend on the extent to which there is a bit of downward pressure still on the yield curve from the bond purchase program.
So just going,
Senator Canavan, as we know, you're at the end of the 10-minute block, but just one more question. Yep.
Just on the, you mentioned before about holding them will limit your losses, or your view will limit your losses. I'm struggling to understand that logic, Ms. Bullock. I mean, because I would imagine the value of these securities will depend a lot, especially on interest rates. Bonds tend to be priced off interest rates, and the future interest rate movements are unknown, uncertain. So has the bank done scenario analysis of different interest rate movements and what those losses would be depending on those circumstances?
We have, but I want to make a distinction between the unrealised losses on the bonds, which you're talking about, and the losses that we will incur because the interest we are paying on our exchange settlement accounts is above the interest we are receiving on our bonds. That is a separate issue, and we have done scenario analysis on that. But the unrealised portion of losses, if you like, on the bonds, that's a separate issue to this issue of scenarios on profits.
Could you table those scenarios?
I can
provide those for the committee?
I can do that.
They're also published in the bond purchase review that we put out.
There were some scenarios there.
Thank you very much. Cheers. Thank you, Chair.
Thank you.